Welcome back. We are now in exercise 6. In this exercise, we'll be reviewing the concepts we discussed in the chapter on term loans. Please take some time to answer these questions and we'll see the solutions. I hope you have answered the questions and got most of them right. Let us see the answers. The first question is, what is the normal cutoff used by banks in India to classify term loans into short-term loans and long-term loans? So we discussed that term loans are classified into short-term loans and long-term loans. So this classification is usually done on the basis of the repayment period. So if the repayment period is greater than 3 years, usually, right, this is the banking norm, this is a classified as a long-term loan, right? Or else it is a less than 3 years, it is classified as a short-term loan. This is not for the CMF classification, right? This is not for the CMA classification. CMA classification, the portion of debt that is falling due within the next 1 year will be a current liability, and the portion of debt that is falling due after 1 year will be a term liability. This classification is different. Okay, this is for the purpose of imposing what is known as a term premium. So if the repayment tenor is more than 3 years, bank impose what is known as a term premium, some 0.25% or 0.5%. They'll be imposing an additional premium, right? So that cutoff is usually 3 years. Okay, it might vary from bank to bank, but this is the usual cutoff. Okay, so the answer to the first question is 3 months. Second question: capacity of the promoters to successfully run the unit is a part of which appraisal? Managerial, technical, industrial, financial. So we have discussed that terminal appraisal is classified into these 4 major appraisals. Okay, managerial, technical, industrial, financial. The capacity of the promoters to successfully run the units. This is the focus of this. The question is asking on the focus is on the promoters. So this is a part of a managerial appraisal. If you recall, in managerial appraisal, we'll be discussing about the credibility of the promoters, the honesty, what is the market reputation, right? What is the opinion? What is the opinion of the promoters in the market, right? What is the past experience? How successfully have they run the unit so far? Do they have the capacity to run this unit successfully? So these are all the aspects we discuss in the managerial appraisal. So the answer to the second question is managerial appraisal. So third question is, which of the following is not part of project cost? Working capital requirement, margin for working capital, contingencies, interest during construction. So if you refer back to our discussion on project cost, we discussed project cost consists of various items like land, building, machinery, and all. We discussed various items. So there is a lastly at the end there is an item called margin for working capital. Please recall that segment. We had a item called margin for working capital. To fully understand this concept, we have to discuss the chapter on working capital, which we'll do in the next chapter. For the moment, please remember that in project cost we have an item called margin for working capital. This is not the total working capital requirement. This is not the total working capital requirement. This is only the margin, the promoter's margin. Okay, margin for working capital. So the answer is the first option. Okay, so this is not a part of project cost. Margin for working capital is part of project cost. Contingencies can be a part of project cost. Interest during construction, yes. Preliminary and pre-operative, this is clubbed under preliminary and pre-operative expenses. So these 3 can be part of project cost. This is not a part of project cost. Okay, next question is, land cost is not included in project cost if it is taken on lease, whether it's true or false. Usually it is true, right? If land is purchased, we'll include it in the project cost. Okay, in the project cost, and the item of land will 5 crores is the cost of land. Okay, if it is purchased. If it is not purchased, usually we treat it as nil. So usually the answer is true, but land cost can be included, right? In case of large projects, very large projects, if the land cost is huge, what they do is they capitalize it. Okay, sometimes the cost of land is capitalized. In that case, we can consider it to be a part of project cost, but normally we don't consider it. We're speaking of some normal cases, so we can take the answer to this as true. Okay. Next question, question number 5. To meet cost of imported machinery, bank sanction which of the following: front-ended FLC or back-ended FLC? So in chapter 9, we'll be discussing about non-fund limits. There we'll be discussing about LCs and BGs. There we'll be discussing about LCs. There will be, as of now, you don't understand what is a letter of credit, so you cannot answer this question. But we did discuss this in the context of plant and machinery with this concept. Okay, so the answer is front-ended FLC. It doesn't matter if you're not clear about this concept. We'll discuss it in chapter 9. For the moment, please understand, for imported machinery, bank sanction what is known as front-end and FLC. Actually, this is not sanctioned as a separate limit. So if the term loan is say 100 crores, and the breakup, say for example, bank has sanctioned 20 crores towards the land cost. Okay, construction 40 crores, plant and machinery 50 crores. Okay, and others 10 crores. So total, this is the breakup. The bank has sanctioned the term loan of 100 crores. So this plant and machinery out of 50 crores. Let us say the indigenous portion is 30 crores and the imported portion is 20 crores. Right? Out of this plant of machinery 50 crores, 30 is the indigenous component and 20 is the imported component. So for this 20 crores, what banks do is they open an FLC known as a front-ended FLC. Okay, so the disbursement will be only to the tune of 80 crores. So out of the 100 crores, they'll be dispersing for all these portions, right? 80 crores remaining, except for this 20 crores, they won't disperse this. So when they will disperse this, LC will be usually having a usance period. Don't be worried if you don't understand all these terms, but for the moment, but since the topic has come, I'm just going through the points. So there will be something called usance period. The LC payment has to be made after a usance period. There will be some time available. So at the time of that due date, say for example the usance is 90 days. So after 3 months, what banks do, they will debit the term loan account and meeting the LC commitment. So the LC payment will be made by debiting the term loan account at that stage after 90 days. So then the term loan becomes fully disbursed. So till that time it will be disbursing only 80 crores. Then when that LC becomes due, that term loan will be debited to 20 crores and thereby the entire term loan will be disbursed. Right now you might not be in a position to understand what LC is, but let us see. We'll see that shortly. The answer to this question number 5 is front-ended FLC. So question number 6, expenses incurred on trail run is example of which of the following? Preliminary or pre-operative expense. So we did discuss this, the difference between preliminary expense and pre-operative expense. Preliminary expenses are expenses incurred for the formation of the company, right? On formation of the company. So these are expenses like registration charges, registration fees for the corporation. You have to pay some fees to the ROC, okay? Maybe some TV report, consultancy charges. So these are all expenses prior to the on the formation of the company. The expenses which incur are known as the preliminary expenses. Pre-operative expenses are expenses incurred for bringing the unit to production. Okay, these are like raw material, wages, bringing the unit to operation. So this trial is actually a pre-operative expense, right? So question number 7, a company has availed term loan for civil works. Okay, interest during construction is capitalized. So where does this interest during construction appear in financial statements? This is something which we discussed. Interest during construction is capitalized. Okay, what do you mean by capitalized? It will be added to the gross block, right? It will be added to the relevant block under fixed assets, and then we'll be depreciating this along with other buildings. Okay, this is something which we discussed. We will not show this portion in the P&L account. In P&L account, we have an item called interest, but this interest is different. The portion which we capitalize is not going to come in the P&L account. When we mean capitalized, what we are saying, we are not going to show it in the P&L account. This is not an interest for one period. Okay, this is an expense incurred for machinery, and this has to be so this is capitalized. Okay, so this will be added to the relevant block of fixed assets, and then we'll be depreciating it along with the other buildings. Okay, so the correct answer is second option. Okay. Question number 8, promoters have to bring in their margin. Which of the following is most preferable to the bank? What is, if you're a banker, which is the most preferable option regarding the borrower's margin? First one, promoters bring in their entire margin upfront before the bank starts disbursing its commitment. Second, the promoters bring in certain percentage of the equity, say 40-50% upfront, and then balance is brought in proportionately. Third, promoters agree that they will bring in funds proportionate to the bank finance. So we have a project of 100 crores, of which bank has sanctioned 80 crores and a promoter's contribution is 20 crores. So the first option is saying the promoters will first of all bring in their 20 crores. So they start the project, the work, the land, maybe the part of civil works. They meet with the margin of 20 crores, and then bank comes into the picture. Bank starts dispersing its 80 crores step by step. So whether this is preferable, or promoters bring in certain margin, say 50%. So 10 crores they bring in, and then proportionately for the remaining 80 crores disbursement they bring in 10 crores proportionately. So bank will be dispersing 8 crores, say. Company will be bringing 1 crore. Next tranche, bank will be dispersing 4 crores. Borrower will be bringing 0.5 crores, ensuring that the proportionate margin is always ensured. Whether this is the preferable scenario, or promoters agree that they will bring in equity funds proportionate to the bank. So from the beginning, so third option is from the beginning proportionate disbursement. So 80-20 is the ratio, right? 80%, so 20% the margin. So first disbursement 1 crore. So borrower has to bring in 20 lakhs. Next, the company asks for 5 crores disbursement. Borrower has to bring in 1 crore. Whether this is the preferable option. So of the 3 options, obviously the first option, if you're a banker, the first option is obviously the most preferable, because the borrower is bringing his entire contribution upfront. He has invested his entire funds. This is a preferable scenario, because bank has not invested even a rupee till this stage. His entire contribution is met. So we have ensured that the borrower's stake is in the business, and then we can start dispersing. Though this is not usually employed in practice, but in cases, as a banker, you have the right to impose it, right? If you feel that the borrowers are do not have the capacity, the financial strength to bring in their funds, you can impose this. There's nothing wrong in it. Based on a case by case basis, you can take a call. Okay, so as a banker, the option one is preferable, though it should be added that this is not the usual practice. Usually you see this. The third option is usually most common, proportionate disbursement. Second option is also common, right? They bring in part of the equity upfront, and banks say you bring in your part of the equity, say 50% upfront, and then we'll start our disbursement. So these two are more common. Okay, but theoretically this is the most preferred option for the banker. Question number 9. Formula for DSCR is as follows. DSCR is profit plus depreciation plus interest by installment plus interest. We have seen this formula. Okay, so in this formula, what does interest mean? So does it mean only term loan interest or only working capital interest, or both term loan and working capital interest? So we have discussed this point when we discussed about DSCR. So this interest is only the term loan interest. Okay, this is the only term loan interest. So in the P&L account, in the CMI data, when you have an item called interest, don't take it straight away into the calculation of DSCR. This interest you have to know what is the term loan interest portion, what is the working capital interest portion. Okay, so you have to take only the term loan interest portion. In DSCR calculation, the interest which we calculate is only the term loan interest, right? Next question, question number 10. Banks do not want borrowers repaying installments somehow or the other. They want repayments to be done out of the profits generated by the company. Is it true or false? This is absolutely true. Absolutely true. See, company repaying funds somehow is not the solution. Say a project is not doing well, company is not generating profits, but the installment has fallen due. Say 1 crore the company has to pay, but the project is not generating enough profits for the company to pay this 1 crore. So somehow it's arranged 1 crore from borrowing outside or pays this 1 crore. Next installment again, not sufficient profits, again 1 crore borrow. So as a banker, okay, this account is standard. The borrower is somehow repaying the installments, but this is not what we want. Though we are happy that the account is not has not turned into NPA, that is the borrower is paying, but then as a banker, what you want is the unit should be viable, right? Because if this continues, if the unit is not doing well, till how many installments the borrower can manage by paying from outside? Okay, so that is the point. So you want the unit to be viable. You want the unit to be viable. The profits to be generated from the unit, and the company should be paying these installments from the unit. Paying somehow is not the solution. It's not the long-term solution. As a banker, you want the unit to be viable. When we speak viable, we mean that the profits of the company, the unit should be sufficient to pay the term loan obligations. Okay, so the answer is true, right? Next question: why is sensitivity analysis conducted? The company may have made a mistake in the assumptions. The processing officer may have made a mistake in the assumptions. The assumptions may be right now but change in the future. So when the company prepares a project report, it prepares some projections, okay, financial projections, projected P&L account and projected balance sheet. So preparation of these financials, the company makes some assumptions. So and so is the production we are going to do, so many tons. This is the selling price per unit per ton. This is the selling price. Cost of raw material per ton is so many. So they make some assumptions and prepare these financial statements. So why is sensitivity analysis conducted? Is it because these assumptions the company has taken wrong assumptions? Has the company made an assumptions, mistake in making these assumptions, or the processing officer has made a mistake, or the assumptions are right, but the assumptions might change in the future? The third option is correct, right? We do sensitivity analysis not because the projections, not because the assumptions are wrong. On the date of the preparation of project report, right, at the stage of appraisal, when the credit officer is doing the appraisal, these projections are correct. Right? So that's why we have taken this in the preparation of the financial. So there is no mistake was done as on the date of appraisal. The problem arises when once the sanction is made, once the project starts, once the implementation starts, some of these assumptions might turn wrong. Maybe the selling price has dropped, so company is not generating enough sales. So maybe the profitability is affected, viability is affected, repayment is not happening. So assumptions are right at the time of appraisal, but subsequently they might change. What sensitivity analysis does is it will consider those scenarios. It will say what if the selling price drops by say 10%? Is the unit strong enough? Is viable enough? Even in that scenario, can the repayment be met? What if the raw material increases by 10%? Right? Can the unit still service the repayment obligation? So that is what sensitivity analysis does. So the assumptions are correct at the time of appraisal, but what if they change in future? It is for that purpose we calculate sensitivity analysis, right? Question 12. In the context of break-even analysis, what is contribution? Variable cost per unit minus fixed cost per unit. Selling price per unit minus variable cost per unit. Fixed cost per unit minus selling cost per unit. So please refer back to the segment where we discussed break-even analysis. The correct option is selling price per unit minus variable cost per unit. So if you recall, the example we considered was an item is selling at the rate of, we are selling an item for 10 rupees per item, and the variable cost per item is 6. The company has purchased a machinery for 1000. If you recall, this is the example, exactly this is the same example which we considered. Okay, so when the company, so for on sale of every product, the company is being left with, is having a surplus of 4 rupees. So when the company has made a sale of this first product, it has a surplus of, it has recovered 4 rupees out of this machinery cost of 1000. When it sells the second machinery, it has recovered another 4. So 4 plus 4 cumulatively 8. Out of this 1000 has recovered 8. Variable cost it is recovering with every sale. That is okay. Machinery cost slowly it will recover. Okay. Third product it will recover another 4. So this will be 12. So when it sells 250 products, right, then it would have recovered completely the fixed cost. Right. From that point onwards, right, there is no need to recover this machinery cost. So it is a profit. This 4 is a profit. Okay. So this 4. This 4 is 10 minus 6. This selling price per unit minus variable cost per unit. This is what we call as contribution. We have discussed this in the segment on break-even analysis. Please refer back to the segment. That is an important concept. So the correct option is the second option, right? Question 13. The present value of rupees 25 lakhs to be received 2 years from now at the rate of 10% is what? There are some options you have to calculate. If you remember, present value, we had a formula. Present value is future value by 1 plus I to the power n. So here we have to calculate to 25 by 1 plus 10%, right? 0.1 to the power 2 years. So this is 25 by 1.1 square, right? So 25 by 1 point. So this is 25 by 1.21. You do your calculation. But this is not the point, right? The point of this question is not to do the calculation. Without calculation, you have to answer the question. That's the point of this question. So please see that first option and the third option cannot be the correct answers. So try to understand the concept here. Let us not focus on the calculation. Okay, let us try to see the concept. The first option and the third option cannot be the answers, because 2 years from now we are right now here now, 1 year, 2 year. 2 years from now you are going to receive 25 lakhs. 25 lakhs today is a big amount, but 2 years from now its value will be less. So if you are speaking of the present value, what is it worth today? It will be definitely less than 25. Please refer back to segment where we discussed about internal rate of return. So we have discussed the concept of present value. Okay, the present value will always be less. The earlier you receive, we discussed this, right? The earlier you receive an amount, the more valuable it is, right? This 25 lakhs, the earlier you receive, it will be more valuable. You are receiving it 2 years from now, so it is not that much valuable. In fact, if you speak of what is its value today, it will be something less than 25. So these two are more than 25. First option, third option. So these can't be the correct option. We can straight away ignore this first and third. Regarding the second option and the fourth option, which is correct? Might say we have to calculate to know the answer, but if truly you have understood the concept, there is no need to calculate. You see, you can work in the reverse way. Okay, take the first option, 22.73. So what we are saying is, if we invest 22.73 today at a rate of 10%, how much it will be become after 1 year? So this will earn an interest of 10% of 22.73 after 1 year. After 1 year, we'll be having 22.73 plus 2.273. Am I correct? Right? Is this correct? So if you invest 22.73 today at the rate of 10%, after 1 year, it's going to grow to 25. Right? So the present value of 25 lakhs to be received 1 year from now is 22.73. So this is also a wrong option. What we are saying is after 2 years. See, our question is asking 2 years. This 25 lakhs would have been the correct answer if the question is present value of 25 lakhs to be received 1 year from now is what? Then we'll say 22.73. So this is not the option. 20.66 is the correct answer. Why? You see here, 20.66 if you invest for 1 year at the rate of 10%. This is the interest portion. You will earn how much interest? You'll get a interest of 2.066. Right. So put together 22.73. Right. After 1 year, 20.66 will grow to 22.73. Then the 22.73, if you again reinvest at the rate of 10%, this will be 2.273, and this will become 25. Got the concept? So you need not actually do the formula. Right. The formula actually, if you want to answer this question, the formula is 25 plus 1 by 0.1 to the power 2. So this is 25 by 1.21. This is, if you calculate, you will get 20.66, but that is not the point of this exercise. I want you to answer without calculating, right? So seeing the options, you can straight away say first option is wrong, third option is wrong. Within these two, you have to find out how much this will grow after 1 year. This will grow to 25 after 1 year, but we are asking 2 years from now, right? So this will grow to 22.73 in 1 year. This will further grow to 25 in 2 years. So the present value of 25 lakhs to be received 2 years from now is 20.66. Okay. So please refer back to the segment of internal rate of return to be more comfortable on this concept. 14, question number 14. IRR is the discounting rate at which NPV is 0, NPV is positive, NPV is negative. This we discussed. NPV is negative. Okay. So IRR. So NPV changes with the discounting rate, right? So we said NPV will accept a project if NPV is 0, will decline if it is less than 0. So NPV can take a range of values. So this NPV will change, right? Say for example, you had an NPV of 5 crores, right? If you considered a discounting rate of 10%, and NPV was say negative 2 crores when the discounting rate was 50%. So somewhere in between, at some discounting rate, NPV will be 0, right? So what is that rate? At that rate, say for example, this is 12%. At that rate, NPV is 0. See, we call that rate as a internal rate of return. So IRR is the rate at which the discounting rate at which NPV is 0. Okay, first option is correct. So the last question, disbursement in term loan should be in a phased manner to ensure that 1. Release of loan is as per physical progress. Release of entire loan at once will result in lower interest income to bank. The first option is obviously correct. We're not speaking of the income to the bank, okay? That is immaterial. That is the secondary thing. Income to the bank is not the point. This is not the point which you're discussing, okay? This is a irrelevant option. You should be concerned to release the loan in a phased manner. If there's a term loan of 10 crores sanctioned to a company, why should not we release 10 crores in one go? Why we release it in phases? Initially 1 crore or 0.5, then 2 crores. In phases, why we release? We have to ensure that the disbursements are in tune with the physical progress. You release 8 crores, right? That is 80% of the loan you release, whereas the physical progress is only 20%. This is a weird scenario. You should not be encouraging these sort of situations. So why do we slowly release in phases? To ensure that the disbursements are in tune with the physical progress, right? Disbursements and physical progress should be a relation, right? They should go hand in hand. So you go on dispersing and see that the physical progress is also there. That is why we ensure a disbursement in phased manner, to ensure that the loan is commensurate with the physical progress, right? So first option is correct. So hope you got most of the questions right. With this we come to the end of the chapter on term loan. We have discussed a lot of concepts in this chapter. Please review them if you're not comfortable, because going forward these are very important concepts, right? In the next chapter, that is chapter 8, we'll be starting a discussion on working capital. Okay, working capital is another important concept. So term loan and working capital are two important credit facilities for a company. So we've seen the appraisal for a term loan. What are the points you need to consider? In the next chapter, we'll start working capital assessment. Okay, see you then.